Hello friends, this is Vijay Bhambwani and I'm back with you in my weekly market outlook video. The markets finally corrected just the way I have been warning you over the weeks that the RBI bond window, the retail direct scheme would eat into the bank fixed deposits. And I have been screaming on my social media about how the cost of funds, the interest rates were likely to rise, thereby pressurizing the corporate sector and pushing up EMIs. Sure enough, all these worries played out. But that's a post-mortem. What do we need to do? I discussed this in the video in a special segment at the fag end. So please do not go away. It's a pretty long video this weekend, and there's a special segment about what actionable game plan I'm going to follow. And if you deem fit, you can follow suit with me. Let's dive right in and basically look at the market roundup window on your screen, which shows that the Bank Nifty fell faster and harder than the Nifty 50. Naturally, it's because the cost of funds went up. I have been warning you in my video dated 27th of November that the selling was not over yet, and that in the following video, the banking space would drag the markets because funding costs would rise. And last week, I told you that the rally was expected to be nothing but a Santa Claus rally, as real as Santa Claus is. This is because mutual funds and FIIs gravy dress their NAVs and massage the returns. Now, I'm glad all my hypotheses over the last 3 to 5 weeks have basically panned out exactly as I expected them to be. Now, staying ahead of the markets is what I endeavor to do, and this is what is the purpose of these videos and my social media posts. So, bullion rose, and that too with a rising dollar, which tells me that there was safe haven buying last week. Oil and gas fell, and if you're connected with me on social media, you would have seen that I have been debunking the super cycle theory in the entire industrial metals and energy space in commodities. The US dollar index, the Dixie, rose and the rupee fell versus the USD INR along with a global basket of currencies. Now, a weak rupee is a worry because India is a net importing nation, and higher landed price of foreign goods, especially energy, which is crude oil and natural gas, can push up inflation. Watch this space very, very keenly. Now, the 10-year benchmark bond yield firmed up, which is again another concern. I'm going to take it up in the bond segment, and it went up to 6.40%. Last week, the National Stock Exchange saw an erosion of 3.16% in the market capitalization of all the shares listed, and that is a big number. Coming up on your screen is the chart of the MWPL, which shows a routine rise in open interest across the market, which is post-expiry of November futures. But the rate of rise in open interest is tepid, unconvincing, and very, very sluggish. Traders are not half as gung-ho and bullish in December as they were up to October. Now, coming up on your screen is a chart of the index and stock futures volumes, and the volumes have been lackluster. As a matter of fact, even subdued up to Thursday when the markets was attempting to rise. But on Friday, the day the markets witnessed a slam dunk decline, there was a spike in volumes, which tells me that participation levels on declines on the sell side is actually rising. Now, that is another minor red flag. Now, let's take a look at the basis chart. The basis is nothing but the premium enjoyed by the future over spot, and on a week-on-week basis, both the Nifty and the Bank Nifty have seen basis erosion. Number one, you have time to expiry, which is getting closer. So time decay also erodes the basis. But number two, selling pressure persisted right till the end of the week, which is Friday, and that too till the last hour of Friday, which is why the basis compressed. Now, should this basis compress very, very rapidly in the coming few days, I would suspect that the selling is escalating. Watch this very keenly because I update this on my social media pages every single day. Do connect with me. My contact coordinates will come at the fag end of this video. Now, for our exclusive in-house study that we have been leaning on extremely heavily, and the study has lived up to our expectation. I'm referring to our impetus chart. Now note how the impetus was falling till the indices were attempting to rise last week, and the impetus shot up on Friday, which was a day when the indices actually collapsed. Now, this is a huge red flag, not just a red flag, it's a huge red flag. The impetus rose on a falling day and it was falling on rising days, which clearly tells me that the market has now started favoring sellers. Ideally speaking, we need rising prices and rising impetus to signal a sustainable rally. Now, that is missing, so the bulls are likely to be on the back foot. Now let's go to the footprint of the four different types of players in the market, starting with the FIIs. Let's see what they've done. Their index net long positions in index futures have come down to 25,584 lots, which last week was 55,829 lots. Their stock futures net long positions have come down sharply as well to 70,356 lots, which was last week 1,58,906 lots. The FIIs for sure look like they are circumspect and cautious. Let's now go to the DIIs, who remain net short across the indices and individual stock futures. Their index shorts actually went up week on week basis to 70,246 lots, which last week was 67,571 lots. Their individual stock future shorts have come down, so they've covered some mild positions in their short side, because the individual stock future shorts are now down to 16,41,239 lots, which last week was 16,71,895 short. Now let's go to the proprietary traders. These are second best to insider information because these are brokers' own proprietary trades. These guys are super sharp traders. They know who's buying and selling. And last week, the index net positions went on the long side to 5,264 lots, which last week was a net short of 17,418 lots. Now, where stock futures are concerned, the proprietary traders actually ramped up their net long positions in individual stock futures to 2,24,014 lots, which last week was 2,728 lots. Let's now go to the retail segment. Retail guys have been doing all the heavy lifting and been buying the most, and they've ramped up their index net long futures to 39,398 lots, which was last week 29,160 lots. Where the individual stock futures longs are concerned, they've ramped them up to 13,46,869 lots, which was earlier last week 13,12,261 lots long. So the retail and the prop traders actually buying, FIIs are circumspect, DIIs seem to be ramping shorts on indices and covering shorts on individual stock futures. Retail segment is again back to doing all the heavy lifting. Let's be careful out there, retail guys. These are extremely volatile markets. Please do maintain your stop losses. Friends, let's now come to the bond market segment. This is a more detailed segment this week because of the importance of the interest rates and what's happened in England. So I'm going to spend a little more time. Do bear with me. Remember, at the end of this video, there's a strategy for what to do in a falling market like this. Now, since this segment is hurting the market most, note how the 10-year benchmark bond yield has hit 6.4%, which means bond traders are expecting inflation to rise and or interest rates to rise in tandem. Now that will hurt corporate bottom line numbers. I told you in my earlier video dated 13th of November 2021 how the RBI's retail direct GSEC scheme could wean depositors away from the bank FDs. Well, that's precisely what happened. Even though the RBI didn't raise rates, the market forces saw borrowers raising rates on deposits. What most people don't realize is that the needles and gauges of the financial markets are actually moved by the big ultra high net worth and high net worth traders. Now, these are big ticket check writers, and therefore they really determine which way the markets go. Now, the ultra high net worth and the high net worth individuals are resisting these abysmally low rates of interest, and this is a worldwide phenomena. Now, there can be a liquidity shock if check writers actually withdraw their funds. Yet, you don't hear about this aspect in the markets. You're being told that falling interest rates will help borrowers to spend more and it helps the GDP. Well, there is another aspect of the same coin. The other side of the same coin is that the savers, the depositors who are putting that money on interest are not really very happy with real effective negative yields. So that's basically going to cause a pull and push in the equity markets worldwide. Last week, the first big economy of the West, which is England, United Kingdom, they raised rates. Now that spooked the market. So far, smaller nations like Hungary, Brazil, Argentina, Peru, Chile, etc. were hiking rates. Now that UK has hiked, there can be a rate war. Now, let me explain why the rate war. I told you that check writers won't lend to, so the rising rates are a given. The late John Templeton said you need to watch what the economy is favoring. Is the economy favoring the borrowers by reducing interest rates, or are they favoring the savers by raising interest rates? In a healthy scenario, the economy should incentivize saving. Now, the world over, governments have been penalizing savers after 2001, the World Trade Center attacks, which triggered off kind of a bear market in 2001 itself. And then 2008 cemented the decline. So falling interest rates have been basically pushing savers into higher risk assets like equities and derivatives and forex markets. So the savers have been trying to get higher yields without really understanding just how much risk they were putting their capital to. Now that interest rates are rising, corporates might see rising input costs, and they will try to trim their input cost by logically cutting salaries of their existing workers, or maybe even reducing the workforce. And automation is already on the rise. Savvy traders are used to the idea of keeping ahead of the crowds, which is why I keep posting so much stuff on my social media accounts and make my YouTube videos as elaborate and as detailed as possible. So smart money has been shifting money from equity to debt because interest rates are now climbing. This will only accelerate. Big boys have started raising rates, and the rate war is highly probable in the months ahead. Now, after UK raised rates, it made its debt markets more attractive to foreign investors. Chances are money will flow from lower interest bearing nations to the United Kingdom. And to stop that flow of money out of their countries, the other countries will also be forced to raise rates. The last thing is that there is a threat perception that asset allocation might just shift. Investors, if the rates rise fast, might take money out of equity markets and deploy that in the debt markets. Now, I've posted on my social media accounts many weeks ago how I'm going for sovereign investments, allocation to post office saving schemes, because They are guaranteed schemes by the central government, and even the interest rates are higher than bank deposits. Remember, I have a game plan ready for you for the coming dip in the market since many weeks, and at the end of this video, I'm going to share details with you. So stick with me till the end of this video. Friends, let's now go to the Dixie, which rose 0.61% and gained on 3 out of 5 trading sessions last week. The price is just above staying above its 25-day exponential moving average, which is a month-long holding on cost of an average bull. As long as the price is above this, the bulls are comfortable holding or even adding to their longs. So the short-term outlook is okay just for now. The weekly chart, on the other hand, shows a bigger bullish candle, which implies higher buying conviction. This is negative for emerging markets, including India, because it results in inflation. Our imported goods are more expensive, and the landed cost, especially of fossil fuels, oil and gas, which are multiplier inflation causing commodities, also tends to rise if the dollar is expensive. Now, on the weekly chart, the price is above its 25-week exponential moving average, which indicates 6 months holding on cost of an average bull. So the medium-term outlook is positive as well. Last week, I advocated a range between 97.05 and 95.05, which held perfectly well in spite of all that volatility. In the coming week, I estimate a range between 97.35 on the upside and 95.95 on the downside. Watch this space very keenly. Friends, let's now go to the Bank Nifty, which fell 4.01%, and last week it's basically fallen on 5 out of 5 trading sessions. It took the brunt of the selling, and the reason I have told you is extremely simple. It's the bond yields and inflation. Now, I feel the situation could get worse. Note how the falls are on fairly large bearish candle. That shows the severity and the velocity of the fall. The price is below its 25-day exponential moving average, which is a month-long holding on cost of an average bull. Ever since the second week of November, the price is staying below this average, which means buy and hold bulls are facing mark-to-market pressure. Upsides will see selling from trapped bulls, which leads to the concept of overhead supply. Let's now switch to the weekly chart, where we see large bearish candles engulfing the previous smaller bullish one. This is called a bearish engulfing pattern. It shows the sellers are overpowering the buyers. Remember the impetus chart that I showed you, which showed a spike on Friday, which was the day the markets collapsed. Now that the price is back below its 25-week exponential moving average, which is a 6-month holding on cost, even the medium-term outlook has turned shaky. In the week before last, this index was number 2 on the most volatile list, but it fell 1 notch to number 3, not because its volatility fell, but because individual stock volatility rose much more faster. Last week, I advocated an estimated range between 38,650 and 35,550, which was exceeded by a mere 15 points. Now, that tells you that a lot of work has been put into our metrics. We advocated a low of 35,550, and the actual low was 35,535. The coming week is likely to see an estimated range between 37,200 on the upside and 34,000 on the downside. The danger still remains present, and the range can be exceeded, especially on the downside. Let me remind you, I still have a special segment, a special update at the end of this video for you. Friends, let's now go to the Nifty 50, which lost 3%. It fell on 4 out of 5 trading sessions, as you can see on your screen. And It fell below its 25-day exponential moving average on the daily chart. Since this average is a month-long holding on cost of an average buyer, the bulls are under pressure as of now. The price is nearing the swing low made in November, which tells you that the upthrust in December was a feeble rally. That was something that our in-house impetus chart already showed. The weekly chart shows a large bearish candle engulfing its previous bullish one. That is similar to the Bank Nifty's bearish engulfing pattern that we saw recently. The price is at its 25-week exponential moving average, which is a 6-month holding on cost of a medium-term player. We are just about breaking even there. That shows that the bulls are not in a position of strength unless they revive the markets as soon as possible. In the week before last, this index was at number 8 on the most volatile list, but it fell one notch to number 9 because the individual stock futures volatility rose faster than the index volatility last week. The range that I advocated last week between 18,025 and 17,000 was breached on the downside marginally because the intra-week low was 16,966. That's a mere 34 points overshoot of my level. The coming week is likely to see an estimated range between 17,525 on the upside and 16,400 on the downside. Here again, the Jensen's measure does not justify aggressive fresh, long leveraged positions. Trade light because as we get closer to Christmas holidays, markets might become illiquid because FIIs do tend to go on leave. The difference between the bid and the offer prices, the spreads will widen. So please keep your positions light, and that too with stop losses. Now, friends, two segments remain. One is the 5 stocks wherein I give you high and low beta counters, and the other, the special segment that I have recorded for this week. Now, the 5 stocks that have high beta, high impetus, where you take small positions, wait for large price moves. The list is led by NAM India. Number 2, TVS Motor. Number 3, Sriram Transport. Number 4, APL. And number 5, HDFC AMC. The low beta, low impetus stocks where you take big exposure, wait for small price move is led by IEX. Number 2, GMR Infra. Number 3, DV's Lab. Number 4, Alchem. And number 5, Deepak Nitrite. Friends, this hierarchy of volatility changes from hour to hour, day to day. So please remain connected with me because I keep updating this stuff on my social media accounts. Now, for the special segment that I have recorded, now the market is likely to get challenging. It's something that I have been prepping you since many weeks. Now that it's actually come, what do? I have 2 screens which you will see on your screen right now, 2 charts. And I'm going to discuss what to expect. Number 1, the broad game plan. Number 2, the action blueprint. You see, the markets rise, they fall. That's routine. And do remember that we traders are brain warriors. We win or we lose with our ideas. So rather than getting into a state of shock when the market falls, prepare in advance. Execute your blueprint that you make and profit from the fall. I'm referring to short selling. Admittedly, it is not an easy task. It's not for everyone. It's for an experienced trader. But market falls are much more faster and vicious than you see rallies. Therefore, declines are a lot more profitable than bull markets. Falls are accelerated by sellers, weakness in the bull camp, and the pull of gravity. Get in, get out on short sales, and make money, go home. Learn the art of short selling. Panicking and freezing up is not going to help you because your existing long positions will bleed you. Now, if you miss this fall, the next one may come a long while away. Make decent trading profits, deploy it in sovereign investments, and when you reach a stage where your home and hearth expenses, your survival expenses is met by your interest income, believe me, you have arrived. Now, trading profits will multiply after you don't have to worry about survival expenditure because you can wait in a trade rather than square it up under pressure. Now, I know bear markets are extremely profitable because in the bear market of Y2K, that is 2000, the crash of 2000, I almost went bust. But in the bear market of 2008, the global financial crisis, I bounced back strongly. I'm now waiting for a decline. Whether it is going to be a bear market or not, I seriously don't care. I just want a decline. I'm going to make a defining change in my life after bouncing back in 2008. So we are prepping. You've been seeing me on social media posting how about inflation, interest rate hikes, super cycle theory, etc. I've been sharing a lot of ideas. All this while we've been preparing for the ultimate move in the markets. So we are going to do that in 2022, and I'm going to let my profits liberate me so that I can go home and help my friends to go home as well. Now, the actionable blueprint is the cost of funds will jump. Find out which companies and which sectors are going to lose because the cost of funds are going to go up. These are your short selling candidates. EMIs will rise over the next few quarters. Find out which sectors depend on EMI-based sales. These are your weak items which you can short. Inflation will rise. There will be some companies and some sectors that can pass on the inflation to their users and some cannot. Find the sectors and companies that cannot pass on inflation to their end users. Short them. Now, my Equity Master video dated 3rd of December 2021 very clearly and openly said NBFCs and by default banks will feel the heat because cost of funds will go up. If you've seen what's happened to NBFCs and banks after the 3rd of December, you know what I'm talking about. If you think the fall is done and over with, I can tell you that the weaker ones still have to fall more. These are again your shorting candidates. Companies with large overseas debt, especially in foreign exchange, that is US dollar primarily, will feel the heat and will fall much more faster. Companies with single stream of revenue rather than well-diversified conglomerate business models will feel the heat and investors will dump their stocks. Now, these are also your weak spots. Friends, before I wind up this video, a word of caution. Like I said, short selling is a risky art. You need to have some experience in shorting, especially keeping stop losses and a little bit of screen reading to see to it that you don't actually go overboard. Do this very, very carefully, and if you get the bear market right or the decline right, it's too early to say whether there's going to be a bear market. I apologize. So if you get the decline right, believe me, the amount of money that you can make in trading a decline can be life-changing. I wish you all the best for the week ahead, and I'm going to stay connected with you on social media as well as in my YouTube channels. If you liked what you saw, subscribe to my YouTube channel if you haven't already done so. In the comment section, do let me know what you think of this video. Help me reach out to fellow like-minded investors and traders by referring my video to your family and friends. Also, in the description below the video are hyperlinks to my playlist on Equity Masters YouTube channel, as well as a free trading guide in PDF format. Do avail of these two features as well. Have a very, very profitable day, my friends. Thank you for your patience till we meet again in my next. This is Vijay Bhambwani signing off for now. Take care. Bye-bye.